Welcome back again, everyone, to today's class on marginal and absorption costing. In our previous class, we have been able to look at the concepts behind marginal costing and absorption costing as a cost analysis technique or tool. Also, we've been able to look at distinguishing features or distinctions that exist between marginal costing and absorption costing. Today, we'll be looking at the principle of relevant cost and relevant revenue. Now, one of those germane topics in management accounting and cost accounting is what we refer to as relevant costing. Actually, relevant costing is a subset or it's erupted from marginal costing. When we get to advanced levels like performance management, that's an ICANN skills level, or APM, advanced performance management in ACCA levels, we will be looking at or coming across a topic like relevant costing. According to what I said, relevant costing is just a subset or a subdivision of marginal costing. But for the purpose of this class, we quickly look at a section on relevant cost and relevant revenue. According to the Chartered Institute of Management Accountants, relevant cost or relevant revenue can be defined as the cost and revenue appropriate, relevant, applicable, useful to a specific management decision. According to CIMA official terminology, I repeat, relevant costing and relevant revenue can be defined as cost and revenue appropriate to a specific management decision. The word is a self-explanatory terminology. It's literal enough to understand. Relevant costs are costs that are appropriate, that are relevant, that are applicable, that arises as a result of specific management decision. Relevant revenue, on the other hand, are revenues that are appropriate, that are relevant, that are specific, that are relatable, that are attributable, that arises as a result of specific management decision. That's just it. So, in case you come across in an assessment or examination condition that you explain the terminology meant by relevant cost and relevant revenue principle. This is what it meant. Cost, revenue that arises, that is appropriate, that is erupting as a result of management decision. Notice the word specific. That is, if we take this particular decision, this is the cost we are ready to incur. This is the revenue or the benefit we are ready to receive. This is the governing principle of relevant cost and relevant revenue. We move forward by looking at what are the specific features, the specific characteristics of relevant costing. Don't forget that these are just domiciled on the elementary level. Probably ATS3 of ICANN, but advanced level actually goes depth beyond this. So, for the purpose of this class, we'll only be looking at just 3 characteristics of relevant cost. Number 1, relevant costs are future costs. In other words, relevant revenue are future revenue. So, when we are talking about a relevant costing approach, we are talking of a cost that we have not incurred now, but we are going to incur in the future. We are talking of a cost, we are talking of a revenue that in the present period might not have been incurred, but in the nearest period, if the decision is actually embarked upon, we are going to incur such cost. So, by implication, relevant costs are future costs. Relevant revenue are future revenue. Costs that will be incurred in the future if a specific management decision is taken. Another characteristic is that relevant costs are differential costs, or relevant costs are, or relevant revenue are differential revenue that differs between alternative decisions. Take for instance, if we produce 10,000 units, we did be incurring 100,000 naira. But if we produce 15,000 units, we did be incurring 120,000 naira. So the differential amount, the difference in the decision of producing 10,000 units and 15,000 units up to the tune of 20,000 naira difference, 100,000 and 120,000 naira. So the 20,000 naira difference, or the cost, the differential cost is 20,000 naira. So we say that relevant costs are differential cost, or relevant revenue are differential revenue that differs. That is the difference between the 2 or more alternative decisions that could be taken. Lastly, relevant cost or relevant revenue involve cash flows. Now you are going to recapitulate this when we are talking about accounting rate of return, and we are talking about that accounting profit is different from cash flow. So relevant cost or relevant revenue involves cash flows.